Welcome back, everyone, here to Live Now from Fox. I'm your host, Mike Pache. Always great to be with you. Thanks again for joining us as we bring you the world of top stories, live feeds, and, of course, breaking news all as it happens. Well, check out the Dow right now, just down about 66 points in the red. We are awaiting the Federal Reserve announcement as the Fed, for the first time since 2020, is set to cut those rates there. A long time coming. So I want to bring in our next guest here to break it all down for us. This is Dr. Christina Kinner with the University of Pennsylvania, Associate Professor. Thanks so much for joining us on Live Now. We appreciate it.
My pleasure to be here. Thanks for having me.
All right, so let's talk about this. Highly anticipated today with the Federal Reserve finally making that cut. Now, some would say, is it too late in the game? What do you say about that?
Well, big picture, you're quite right. It is a big day, both for financial markets and for American households. The Fed has been raising interest rates. It's raised interest rates 11 times since early 2022 to deal with this decade's high inflation. Consumers have been feeling the squeeze of the higher cost of credit, coupled with higher prices everywhere, grocery store shopping caused by inflation. So the Fed is meeting later today. As you said, not a huge mystery about what is going to happen. The Fed has been signaling a September interest rate cut for a number of months. So the market and the American public is very much expecting an interest rate cut. And the only question really is whether it'll be 25 basis points or 50 basis points. And that really leads right into your question of whether the Fed is too late or not. My opinion is the Fed is not too late. And in fact, the Fed has faced a really tough decision about whether to cut and in particular how much, given its conflicting objectives and the variety of economic data that's been coming in.
And let's also talk about the way that the Federal Reserve really has to walk this line here, because we're talking either 25 basis points, 50 basis points. Even some Democrats yesterday were calling for 75 basis points. So talking about the line they have to walk, if they do too much, does that signal to the market that, hey, we need a drastic change fast?
Exactly. They're walking a difficult line. They're really trying to thread a needle because, on the one hand, they're not finished with their fight against inflation. So the Fed's inflation target, how it defines price stability, which is its part of its dual mandate, a really important part of its dual mandate, is defined as 2%. The Fed isn't there yet. Inflation is still around 2.4%. So granted, there's been a lot of progress. Those rate hikes were absolutely necessary to get us closer to 2% when inflation had creeped above 9% at one point. And so that's very much top of mind for the Fed. It doesn't want to lose progress toward 2% inflation by cutting too fast, too soon. On the other hand, it's also trying to engineer what's referred to as the soft landing, which is to say, stick that 2% landing without tripping the economy into a recession. And so recently, the Fed is being sort of more mindful of the fact that it sees some information from the labor market suggesting maybe the economy is starting to cool down. So, for example, in August, we saw that there hadn't been as much hiring as we'd seen in prior months. And so the question is a rate hike now needed to avoid that recession, to accomplish that soft landing without losing a grip, without losing progress toward inflation? And so 25 basis point would certainly be a more conservative way to deal with those competing objectives, right? Not losing progress on inflation, which the American people really care about, and still being mindful of the fact that maybe we don't need as much of a rate cut to deal with a slightly cooling labor market, because the economic data overall, the American economy is still doing pretty well.
And so that announcement, of course, happening 2 p.m. Eastern, and then we hear directly after from the Fed Chair, Jerome Powell. And Dr. Kinner, I'm always fascinated watching when the Fed Chair is talking, and then also watching the markets, seeing how they are reacting to what some of his answers are to the questions. What are you going to be gearing in on some of his statements to see what he will be talking about and eventually about the market as well?
Exactly. Markets will be very homed in on what Chair Powell is saying because they'll want to understand what the trajectory of rate cuts will be. So, for example, if the Fed were to choose to cut by 50 basis points, there would be a real question about whether that's to be expected at the November meeting and what the trajectory will look like from there. If the Fed were to conversely go with a more conservative 25 basis points, then the question is, should we expect a more muted rate cut going further? And of course, all of this is complicated by the fact that we have an upcoming presidential election. And so I'm sure, however, Chair Powell couches the decision to cut interest rates, he'll want to make sure that he has in view how markets and the public are thinking about the Fed operating in this difficult political time as well.
And because it is a political year, should there be some sort, okay, in the September before an election, should there be just no changes to policy? Because it seems like either way, and no matter what happens, it's going to be perceived as political.
Well, that's quite a difficult dilemma also that the Fed finds itself navigating. Now, the Fed will certainly maintain, as it does, that its monetary policy decisions are driven purely by economic data without regard to what's happening in the presidential election cycle. That is sort of the very definition of an independent central bank. At the same time, it's impossible to ignore that we have a presidential election unfolding where the economy is a top issue for most, if not all, voters, thinking about how difficult economic times have been in the past couple of years compared to the prior administration. And of course, cutting interest rates will have the byproduct of improving the cost of credit, the availability of credit, and sort of make consumers feel a little bit better about their economic well-being, even if that is, of course, not the intended effect of what the Fed will do with its interest rates. So because of this dynamic, it has historically been the practice that the Fed has not changed interest rates in the months immediately preceding the election. So, for example, at this September meeting, and there have been a few exceptions to that, for example, right before the 2008 presidential election, when we were in the midst of a recession that had accompanied the global financial crisis. Lehman Brothers had failed a couple of months before. So there was a very clear emergency that warranted Fed action, notwithstanding a presidential election. Here is a little bit more of a mixed picture. Certainly, the Fed has very valid reasons for wanting to avoid a recession, that we're clearly not in the midst of an emergency that demands a rate cut. And so it's a little bit more of a judgment call. And I'm sure the Fed will be very conscious of this difficult situation and try to explain to the American people that its rates decisions are very much meant to be separate from the presidential election.
Well, Dr. Kinner, thanks so much for joining us on Live Now from Fox. Always fascinating to see the geopolitical nature is with the economy and everything that is going to be happening a little bit later this afternoon with the Fed Chair Jerome Powell. We always appreciate it here on Live Now from Fox. Great job at breaking it down for in such layman's terms for so many that are just wanting to see what's going to happen with the economy coming up. We appreciate it.
My pleasure. Have a good day.
You as well. Take care.